Are you tired of staring at market charts, feeling like you're missing the hidden language they speak? Do you ever wish you had a crystal ball to predict future price movements? While I can't promise you a crystal ball, what if I told you there's a powerful, yet often overlooked, analytical tool that can bring a whole new dimension to your understanding of market cycles and potential turning points? A tool that harnesses the very essence of natural laws to uncover patterns in seemingly chaotic data? Today, we're diving deep into the fascinating world of Newton charts. Now, before you dismiss this as some arcane, overly complex theoretical concept, hear me out. Newton charts, while rooted in profound mathematical principles, offer a remarkably intuitive and visually compelling way to analyze market behavior. They're not about predicting the precise tick-by-tick movement of a stock, but rather about identifying the underlying energetic currents and potential inflection points that drive broader market trends. Think of it less like a precise GPS for your trading and more like a sophisticated weather map for the market, helping you anticipate the storms and the clear skies. So, what exactly are Newton charts? At their core, they are a graphical representation of market data, overlaid with mathematical constructs derived from Isaac Newton's laws of motion and gravitation. You might be thinking, what do physics and markets have to do with each other? It's a valid question, and the connection lies in the concept of cycles, forces, and equilibrium. Just as celestial bodies move in predictable orbits governed by gravitational forces, markets, too, exhibit cyclical behavior influenced by a multitude of forces, supply and demand, investor sentiment, economic data, and geopolitical events. Newton charts attempt to model these forces and their impact on price and time. Let's break down the fundamental components of a Newton chart. The most prominent features you'll encounter are arcs, angles, and sometimes even spirals. These aren't just arbitrary lines, they represent specific mathematical relationships and energetic pathways. First, we have the concept of time cycles. Newton's laws emphasize the importance of time in motion. In markets, time is crucial. Prices don't just move, they move over time. Newton charts often incorporate specific time cycles, which can be derived from various sources, astronomical cycles, natural rhythms, or even just mathematically derived periods. These time cycles are then projected onto the price chart, often as vertical lines or time-based grids, indicating potential turning points or acceleration/deceleration zones. Imagine a pendulum swinging. Its movement is cyclical and takes a predictable amount of time to complete a full swing. Markets, in a similar vein, can exhibit rhythmic expansions and contractions. Next, and perhaps most visually striking, are the arcs and angles. These are typically drawn from significant highs or lows on the price chart. The angles often correspond to specific degrees, like 45, 90, 135, or 180 degrees. These angles aren't random, they often represent key resistance and support levels, or points of energetic culmination or reversal. Think of a force acting on an object. The angle at which that force is applied dictates the direction and magnitude of the resulting movement. Similarly, in markets, price often reacts to these specific angular relationships, forming a kind of geometric harmony within the chaos. Some theories suggest these angles relate to natural Fibonacci ratios and sacred geometry, further connecting them to universal principles of design and growth. Then, there's the concept of squares and grids. Often, a significant high or low is used as a starting point, and a square is projected from that point, with its sides extending in both price and time. The corners and midpoints of this square can then act as projected support and resistance levels, or time-based turning points. This harks back to the idea of a balanced equilibrium. When price and time are in square or in opposition, it can signal a moment of significant energetic shift. Imagine a balanced scale. When the weights on both sides are equal, it's in equilibrium. Markets, too, seek moments of equilibrium before their next directional move. So, how do we actually use these charts for analysis? This is where the rubber meets the road. The beauty of Newton charts lies in their ability to provide a contextual framework for your existing analysis. They're not a standalone magic bullet, but rather a powerful overlay that can confirm, enhance, or even challenge your current market perspective. Step 1. Identify key anchor points. The first step in constructing and interpreting Newton charts is to identify significant highs and lows on your price chart. These are your anchor points. These could be major swing highs or lows, all-time highs or lows, or even significant pivot points that marked a major shift in market sentiment. The more significant the anchor point, the more potent its influence on the projected arcs and angles. Step 2. Apply the tools. Most charting platforms don't have a built-in Newton chart button. You'll often need to use drawing tools like Gann fans, Fibonacci arcs, or custom scripting if your platform allows it. This is where a little bit of manual work and understanding of the underlying principles comes in. For example, to draw a Gann fan, you'd select a significant high or low and then project lines at specific angles. While Gann's work predates Newton's, the underlying principle of angular relationships and time-price symmetry shares a common thread. The key is to experiment with different angles and starting points to see which ones resonate most with the historical price action. Step 3. Look for confluence. This is the crucial step. Don't just rely on one arc or one angle. The power of Newton charts comes from the confluence of multiple elements. Look for areas where several arcs intersect, where an angle aligns with a key horizontal support/resistance level, or where a projected time cycle coincides with a price pattern. These points of confluence are your high probability zones for potential reversals, accelerations, or consolidations. It's like multiple indicators all flashing a buy or sell signal. The more signals that align, the stronger the conviction. Step 4. Interpret the interaction. Once you've identified these areas of confluence, observe how price interacts with them. Does price bounce off an arc with precision? Does it accelerate through a projected angle? Does it consolidate around a time cycle? These interactions provide valuable clues about the market's underlying energy and its next likely move. If price respects these projected lines, it suggests a strong underlying harmonic structure is at play. If it blasts through them, it might indicate a powerful new force taking over. With that said, thanks for watching, and until next time.